A study found 90% of people investing in the stock markets themselves lose money, and 99 out of 100 mutual funds fail to beat the market. Hi, this is Mosh. Today I'm going to be talking about exchange traded funds, specifically about Vanguard. Vanguard ETFs are available on Trading 212. Personally, I would stick to buying Vanguard ETFs through Trading 212 because there's no account fees. If you buy through Vanguard, they charge 0.15% up to a total value of £375. Also on Trading 212, you can buy fractional shares. So what that means is if a Vanguard share is £50, you have to buy one share for £50. Whereas on Trading 212, you can buy a fraction of that share. You can buy £5 worth, which is 1/10 of that share. Before we go into Vanguard ETFs, we need to talk about why people fail investing in the stock markets themselves. First thing is the timing of the market. A lot of people get the timing of the market wrong. We also have this big ego that we can pick individual stocks that are going to be winners. Only a handful of people can do this, and that's why they're the superstars of the investing world. People like Warren Buffett, Michael Price, and Peter Lynch. That's the reason why they're household names. We also tend to focus more on price of the stock than anything else. Individual investors do not look at the operating business, what the company is doing day to day, how they're running the company, have they introduced new people, new technologies into the company. First of all, what are ETFs? ETFs are also known as exchange traded funds. They're a basket of shares. So instead of you trying to find the needle in the haystack, you're buying the whole haystack. You're exposed to hundreds, sometimes thousands of stocks. You can also trade ETFs like stocks. You can buy and sell anytime. However, ETFs should not be traded like normal stocks. They should really be held for long term. And remember, if you want a free share worth up to £100 with Trading 212 or free trade, all you have to do is open an account using my links below, deposit £1 and they'll give you a free share worth up to £100. ETFs have very low fees, and the reason I'm talking about Vanguard is because they are the lowest in the whole industry. They are so cheap. Because of diversification, your risk is spread out. So if one stock tanks, it's not going to really affect your whole portfolio. You also get passive income from dividends from a lot of these ETFs. There's two places you can buy ETFs. So the first thing is through your broker. I'm using Trading 212, so I'm going to buy it through there. Or the alternative is going direct to the Vanguard website and buying it through them. Now, as I said, Vanguard charge a 0.15% fee, whereas you save that money buying it through Trading 212. There are loads of Vanguard ETFs. I'm going to go through the 3 most popular ones in the UK, but obviously it's up to you which one you want to buy into. What I'm going to do, I'm going to go on the Vanguard website and look at each individual fund. The most popular one is the Vanguard S&P 500 with the ticker symbol VUSA. It's the UK version of the VOO, which is a US version of the same thing. You don't want to buy the VOO, the US version, because you'll be hit with something called the withdrawal tax. So if you get dividends from US stocks, you have to pay a 30% withdrawal tax on those dividends. However, being a UK resident, you can fill in a W8 Ben form, which reduces that to 15%. So this is the VUSA. As you can see, the current market price is £55 and you're invested in 507 stocks. So this is where the diversification and the risk spreading comes in. It has a very low fee of 0.07%. As I said, Vanguard is the lowest in the industry. That's why they're so popular. Each ETF is also given a risk level. Stocks will always be a higher risk than something like bonds. Now, the objective of this ETF is track the S&P 500 index, so the top 500 companies of the US. By buying this ETF, you get a share of each of those 500 companies. You can also see the past performance for the last 5 years. Another good thing they have on the Vanguard website is it shows you if you were to have invested $10,000 5 years ago, what that value would be today. If we were to invest $10,000 in March 2016, that amount would have been just over $20,000 today. You can also see the portfolio data. So you can see it's 100% North America, which is the US. It also gives you weighted exposure. So as a percentage, what industry or sector they're in. Now, the key thing to look at is the holdings, what company they're actually invested in. So you can see Apple is around 6%, Microsoft around 5.5%. The top 10 US companies make up 25% of this ETF, because it's based on company weighting. So the bigger the company, the more weighting it will have in that ETF. There are a couple of disadvantages with this ETF. Firstly, the top 10 US companies make up 25% of the index. So if something was to happen to one of those top 10, that will massively affect that ETF. Your exposure is also 100% in the US. So if something was to happen to the US economy, that will hit their ETF very hard. Vanguard has a lot of different ETFs you can invest in. I'm not going to go through all of them, just the most popular ones. So you get understanding of how this ETF works and what you should be looking out for. Next up, we have the FTSE All World ETF with the ticker symbol VWRL. This ETF invests in companies all around the world, including the US. So your diversification increases massively. You can see the market price currently is around £82. Buying this ETF gives you exposure to 3,527 stocks. So that is a lot of companies you're investing in. It has a charge of 0.22%, slightly higher than the Vanguard S&P 500 ETF, but still very, very cheap. Again, you can see the past performance for the last 5 years. It also gives you past performance based on lump sum. If you were to invest $10,000 in March 2016, that would have been worth just over $18,000 today. If we jump into the portfolio data section, you can see by what region. So the US makes up about 58%, Europe, Pacific, emerging markets. So it gives you an overview of what countries or what areas your money is going into. It also breaks it down by country, so you can see exactly what country and what portion of it is going into each country. You also have a breakdown of sector. Next, if we look at holding, and this is where it gets interesting, you can see if we look at the holding, Apple makes up 3.2% of the fund. Then you got Microsoft 2.8%. A lot of the top companies are US companies. There are some Chinese and Japanese companies in there as well because it's done by weighting. So generally around the world, the biggest companies are the US companies. This is the only issue I have with this ETF, because if you bought the Vanguard S&P 500 and you bought this, you're still invested in very, very similar companies. Vanguard have loads of different ETFs, so you got to choose the right one for you. They also have ETFs which are all made up of bonds. Bonds are basically government IOUs. They're generally considered as the safest investment and the least risky investment you can make. The key point you need to understand about ETFs, it should be about long-term investing. The annualized rate of return for the S&P 500 is around 9%. So what that means is if you were to put £100 in every single month for 25 years, your final investment would be worth £113,000 with a profit of £82,000, and that's £100 a month in the S&P 500 ETF. Also, Vanguard ETFs can form part of your ISA allowance, and the ISA allowance for the UK is £20,000 per tax year, and it just reset on the 6th of April. Now, if you're thinking if you should put it all into an ETF that's made up of 100% stocks or 100% bonds, this is a rule of thumb you should be using. The stock to bond ratio is based on your age and risk level. Remember, I'm not a financial advisor, this is just guidelines. So if you're between 20 to 30 years old, you should be 100% in stocks. If something bad was to happen, you've got time to recoup your assets again. If you're 30 to 40, it should be 75% stocks and 25% bonds. 40 to 50 is 60% stocks, 40% bonds. 50 to 60 years old, it should be 50% stocks, 50% bonds. These are just guidelines based entirely on your personal circumstance. So you gotta figure out what works for you. Now, if you're not sure how to do this, there's a really good app that I'm using called Invest Engine. They actually manage your portfolio for you and they invest in various different ETFs, so your risk is spread and you have that diversification. They also charge a very low fee of 0.25%. And what they're also doing is they're offering you £50 free bonus if you invest £100 using my link in the box below. Just bear in mind, you have to keep the £100 in there for a minimum of 12 months or you'll have to return the £50 bonus back to them. So definitely go check them out. They're very, very good.